What's the most important resource that you have? If you really thought about this deeply, I think you'd come to the same conclusion that Joey and I did. It's time. In our newest book, What's Without Wall Street, the 3 Steps to Financial Freedom Through Passive Income, we talk about how are we tracking that time? What is the thing that we can do to get more of that time back?
That's right. If you've ever been listening to our podcast and thought, man, it would be amazing if I could take all the things that you guys have learned over the last 10 years and just summarize them, put them in some way to easily digest them and take action, that's what this book is all about. You're not going to want to miss it. Go to wealthwithoutwallstreet.com/new book and get your copy today. Wealth Without Wall Street Tribe, you've heard him on his podcast, Invest Like a Billionaire, and you have heard him on our show before. Welcome back to the show, Ben Fraser. Ben, thanks. So glad to have you, man.
Yes, thanks for having me, guys. Looking forward to our chat.
Well, this is one of those talks where we talk a lot about how do we build more passive income than we have monthly expenses. And I think today, Tribe, you're going to get a chance to hear Ben share both insights around macro trends that could impact our passive income, but also sometimes could help us reduce our monthly expenses. So this is a conversation, Ben, I think it's going to be a little bit wide open. I'm going to give you the floor to start off with because you can help us set the stage for what you're seeing currently in the marketplace that maybe we need to be talking about and thinking about as an investor.
Yeah, absolutely. Well, again, thanks for having me on, guys, and love your community, what you guys do. And I think we're so aligned in our goals for helping people learn about investing. And that's really our goal too at the Invest Like a Billionaire. As a podcast we created really kind of out of a way to get more information to our investors because I'm the chief investment officer at Aspen Funds. And so my day job is actually trying to make money, with investments and then try to be like you guys, educating on a podcast. And, what's really interesting, so I'm one of 4 partners. And it's been really cool to be partnered with people that have been around for a long time in the investing world because they've seen so many cycles. They've seen so many ups and downs and things that you never thought you'd see. And it's given me a lot of perspective. But one of the things that's kind of become a core part of how we view the world of investing is what we kind of call a macroeconomic lens. And so our tagline is, macro-driven alternative investments. And the idea is understanding the big picture, understanding the macroeconomic trends that are going on right now, really create the first step, really create the landscape and framework that then dictates where the best opportunities are and where you should be spending your time learning, the investments you should be making, and starting from there. Because so many people start kind of bottom up where, I ran across this opportunity and, you throw some money here and I run across this thing and throw some money here. And you kind of do that over enough period of time and you kind of have this, haphazard approach to investing. And that's not helpful, right? You guys talk about it all the time, but you got to have a clear goal, clearly define your what you're shooting for and then create a path to get there. And I think the very first step of that path is knowing where we're at in an economic cycle, what things are going to work in this environment, and how do I as an investor participate in that?
So Ben, what cycle are we in right now?
Yeah. So, there's, I think a really helpful framework for people to understand is there's a difference between the stock market and the economy, right? And so a lot of times those get conflated in investors' minds because they're watching CNBC or they're seeing the talking heads on the news talk about, the Dow dropped, 300 points today. We got a bad report on jobs or whatever it is. And there's a lot of volatility. There's a lot of ups and downs in the public markets, the stock market. And what most people kind of take away from that subconsciously is no one knows what's going to happen tomorrow, right? It's anyone's guess if the market goes up or goes down. And so there becomes this assumption that we can't really know where we're going. But if you take a step back and if you look at bigger picture trends, underlying economic fundamentals, supply and demand, interest rates, looking at Fed policy and these big levers that move the economy in different directions, you can begin to see directionally where something might go over time. You may not know the exact day or month or even year, but you can know you position yourself and your investments in a way that's going to be supported by these longer term trends. So, examples are understanding the point of the cycle you're in is so important, because if you're investing in, single family homes in 2005, 2006, it's not a great time. It's top of the market, right? If you're investing in .coms in, 1998, 1999, you're investing the top of the market. You fast forward a couple of years and, it's a very different story. And even the same in multifamily and commercial real estate in 2021 and 2022, a top of the market cycle. And so we're right now in a correction phase. What's really interesting about this, correction, quote unquote, is we haven't had a true technical recession. And, the big question mark is, are we going to have a soft landing or not? That's really being driven by the Fed policy. And, as we stand right now, we're talking, in August, and, September is a big month with what the Fed decides to do from a rate standpoint, for a lot of reasons we can get into. But, we're at a point of the cycle where things got really heated. Cheap money was available. A lot of stimulus was pumped into the economy. Inflation was out of control. Interest rates had to rise to slow down the growth. And so we're kind of in this weird in between, right? Things feel more expensive than they were a couple of years ago. Growth is a little bit slower. Debt's a lot more expensive. And so everyone's kind of waiting to see what happens from here, right? So it's a very, very important time to understand where we're at, the things that can really impact and move the needle from an investment standpoint, and get on the right side of these things.
So I'm running a business right now, and I'm trying to figure out, where should I should I be betting on the future, or should I be in a more defensive posture? Right. So we've got a lot of issues here, and I'm giving you an opportunity to take whatever side you want to and go with whatever angle. But yeah, should I be bullish or should I be bearish right now as it relates to, maybe it's investing in my business, maybe it's investing in a certain specific asset class. Do I think the interest rates are going to come down? And if so, how will that impact me in different ways? But I'm, you're talking to a small business owner right now who is trying to figure out what's the best path to not only scale their business, but also to start building passive income streams on the side. Talk to me like I'm Joey, right? That I don't understand these big terms, and you're having to dumb this thing down to his level. Help me understand.
I mean, that's going to be hard to do, but I'll try for Joey's sake here.
You guys know I'm listening, right? I mean, I'm still on the call, okay, on the podcast.
I thought you were muted. You can hear us. Yeah, I mean, you're asking the question that everyone is asking, right, at every level of business, because that's the same thing, big international companies are asking is, should I be investing for growth? Should I not be? And as a small business, I think it's even more acute, because the impact of these rising costs, labor is probably the biggest one, right? We've seen wages increase a lot the past few years. And, employees have had, up until maybe the past few months, really the upper hand. There's a lot of opportunities. Unemployment is very low. Wage growth is very high. It's a lot to retain people. And usually labor is the most expensive line item for a business. And so it's a very challenging time when these, especially for small businesses, things can really impact the bottom line. In a general sense, I think one, you got to know, do I believe in my business? Do I believe in the future of this industry and the growth of this? Because that's the first question, number one, you got to answer. But then the other piece of it is, actually take it as opportunity to become more efficient. We're in the same boat right now, because, our business is building a big pipeline of future revenue, and we, realize a sale of an asset. But because interest rates are a lot higher, a lot of those have been deferred, right? So we're having to, a lot of our compensation, our future revenue is being pushed out, further and further out. And so we're kind of forced to become more efficient, forced to, create structures that, have more variable expense versus fixed expenses, right? But we're also massively investing into our business, because we know where it's going. We know, hey, this is a little bit of a blip. And even on the investment side, industrial is a vertical we're very, very bullish on. We can talk about it if we wanted to, but we are doubling down right now. It's really, really hard to get a deal done, because that's, hard to get. Banks don't want to lend. Equity is a little harder to find, but we believe so much in the long-term trends because we see what's happening behind the scenes, right? It's maybe a little bit of a slowdown of more companies coming and building manufacturing facilities in the U.S., but we're at the beginning of what we think a decades-long trend of reshoring and nearshoring and bringing manufacturing back to the U.S. that is not going to change anytime soon. It's just a little slower right now, but it's going to massively tick up as soon as, interest rates and the economy come back on. And because of that, we want to get in front of it because all signs are pointing to really good time if you can make a deal happen right now because everyone else is pencils down. And so we're trying to get ahead of the curve. So I think there's a similar approach of if you can see the investments I'm making right now, maybe it decreases my profit margins a little bit, but I know the growth, I know the potential. And then as those costs come down, whether it's the debt service costs, whether it's labor costs, those can create future bigger opportunities down the road.
So Ben, I want to dive into some of what you just said about industrial and the reshoring. I think that there's a lot of things we can really get your perspective on from that. But before I do, you mentioned something in passing I don't want to miss. You said we're currently deferring some of those asset sales, and you didn't specify what those were. Like, could you tell me, are they all in the same asset class? Or are they different? Like, what are those assets that you're having to defer right now?
Yeah, so it's mostly real estate. That's most of what we do. We do real estate and oil and gas. And we have assets in multiple different asset classes, self-storage, multifamily, and industrial. And, several of our business plans contemplated a potential sale around this time, right? But it's not a great time to sell. Values, depending on the asset class, are down anywhere from 15 to 30%, depending on, which area, which asset class you're talking about. But I also know one of the best things for real estate is inflation. And so if we continue to have high inflation, I'm okay to wait a little bit longer because I know the values of those properties will be higher down the road. And even though the reason his values are down right now is mostly because higher interest rates, right? Because to go purchase a property for the same cap rate you purchased it 2 years ago, you're taking on what's called negative leverage. So basically your yield that you're getting day one can't pay the debt service, right?
So break that down for me. If I bought $1 million asset today as compared to 4 or 5 years ago, what does that look like? Help me understand how that negative impact has happened.
Yeah, sure. So let's do it for a multifamily because I think that's what most people are familiar with and it's easy to talk about. So say you have $1 million multifamily property that you bought in 2022. You said 5 years, but I think the peak was probably 21, 22. So that is probably right now, just for simple numbers' sake, worth about 25% less. So it's worth about $750,000 if you sold right now. So say you're cash flowing at say you could have sold the property at a 5% cap rate, 2 years ago. Well, if you're going to sell it at a 5% cap rate now, the new buyer coming on, their borrowing costs for interest are probably in the high sixes, low sevens, right? So they're buying a cash flow yield of 5%, which is what a cap rate is, right? Unlevered yield. And then they're taking on debt at 7%. And so it's called negative leverage. They actually are having a negative yield on that asset. Now, why would someone do that? Because people actually are still buying negative yield, which seems kind of crazy, but the idea is you expect the future yield to go up because the income will go up as inflation, inflates the values.
So as an example, if I bought a property that was $1 million, I know we're using really simple numbers and these numbers are never the simple, but if I bought a property for $1 million that was paying 5% with no mortgage on it, right? Like then I'm getting that, what is that? $50,000 a year in income. True?
Yep.
But yet if I had to borrow the $1 million to get into the deal at 7%, just simple math, and I realize there's principal and interest, but just simple interest, I would be paying $70,000. So my income would be 50, my expense would be 70. So I'm upside down $20,000 just in that equation alone.
Exactly. Yeah. And that's what you just said right there is the story of most commercial real estate right now. Right. So, there was really cheap debt. whether you got fixed rate or floating rate is, a whole other conversation, but that's the challenge. And that's why the transaction volumes are down 75% this year, is because no one wants to sell and take a loss. But let me extrapolate this example a little further. Okay. So let's say, the reason interest rates are higher right now is why? Inflation is higher, right? And that's one of the Fed's mandates, is to keep inflation at a reasonable level. And they have identified that to be 2%. So inflation is higher. Let's just say, for simple numbers again, it's 5%. Well, if I don't sell right now, I'm going to sell at a 7% cap rate, or probably maybe even higher. So I'm actually going to take a loss on my property. But if I can hold on for a couple of years, so say inflation is 5%, and so now my income is not $50,000, it's over a couple of years, say it's now $60,000. Well, now interest rates have come down a little bit at that point, likely, and maybe that they're not a negative leverage situation, so I can sell it closer to that cap rate maybe that I bought it at, maybe not quite the same level, but close. And now I've increased my income, right? And I can sell it back at that a lower cap rate. All of a sudden, you have a multiplicative value on that income. So at a 5% cap rate, every dollar of income you generate equates to about $20 of value. So that's where, if you can continue to drive more income, you're going to have higher values down the road. But the challenge, where a lot of the stress we're seeing in the commercial real estate market right now, office aside, is a whole different conversation, is a lot of the people that bought these properties a couple of years ago used floating rate short-term debt. So most of them have 3-year terms. Those terms are coming due. And because interest rates are higher and the income is not what they thought it was going to be, they don't have enough cash flow to get a refinance and actually pay off their current lender. And so a lot of them are forced to, sell at a loss, or have to put cash in, a cash in refi, right? That's the opposite of what you usually want to see, to make a deal, perpetuate longer. So that's what's happening right now. But if you can hold on for a while, inflation is the real estate's best friend. And if you can wait for a long enough time period, inflation is going to increase the revenue and likely the income of the property. And so you're growing the property. And so you're waiting for those cap rates to go back down again, which is going to increase the values. And so that's really the mentality right now, is how long can you hold on and let inflation continue to drive more value?
Tribe, listen up. We're entering into the election year. This is the time where people are going to get super fearful. We're going to see businesses start to dry up. We're going to see opportunities, though, pile up for us, only if we're prepared.
That's right. You get to choose right now. Will you allow this time frame to negatively affect you in your business and your investments? Or will you be prepared to take advantage of these huge opportunities that come on the backside of this because you're prepared with cash?
Let's get our house in order. If you haven't already maximized the infinite banking concept in your life, here's the chance for you to start learning. Go to wealthwithoutwallstreet.com/IBC. Take our free webinar so that you can start getting equipped with the things that you need to know so that you can take action on this looming event.
You just said inflation is kind of like Russ's haircut. Even if it's bad, it'll grow over time and come back to normal. I like that analogy. But talk about in the multifamily space, when these deals are blowing up like this, when you said, hey, these short-term loans are now coming due and they don't have any option, like they're either selling at a loss or they're calling their investors for more money to put in just to keep it afloat. They're obviously not paying anything out to investors, which we've heard numerous people say, man, I'm just disappointed. I was investing in this deal. It's not paying anymore. It stopped paying, whatever, those are kind of the terms that are being thrown around. What other options are out there? Like, what are you seeing that are maybe, helping those deals that you can take advantage of?
Yeah, it's a good question. There's a lot of pain for investors right now because, multifamily specifically has been the darling of real estate investments for most syndications and passive investors for a while. And that's where a lot of the pain is being felt. So It's interesting because if you look at the underlying fundamentals of multifamily, we actually still have a pretty big housing shortage, right? And it's projected to only get more acute over time. What's happening right now is really interesting because it's kind of all these negative forces are converging at the same time. So one, you have, higher expense for your interest. That's obvious. We talked about that. The other piece is your operating expenses are substantially higher than they were just even a year ago, right? Insurance costs have skyrocketed. I'm seeing renewals for premiums go up, 50 to 100% year over year. I mean, it's insane increases. Property management, it's, hearing lots of challenges with, finding good people to manage the properties. So you have operational costs that are increasing. And then what's happened is there's been so much new supply being delivered. We're seeing record numbers of new apartment deliveries. I mean, all the projects that were started a couple of years ago when there was cheap money are now completed and they're leasing up. We're seeing record numbers of supply in a lot of the high growth markets. So it's suppressing, there's just too much supply, not enough demand in the short term. So it's suppressing the revenue, suppressing rents, and increasing vacancy, increasing the need to run specials and incentives, concessions to get people to move in. So it's all these factors, right? Lower revenue, higher expenses, higher debt service, like every factor is going against all these properties. But if you zoom out and look for the next 5 years, new construction starts, which is a very significant leading indicator, meaning the new construction started right now will create supply 2 to 3 years from now, right?
Right.
And so you can kind of get a sense of what the market's going to look like a couple of years from now. And it's fallen off a cliff, as you'd expect, because the numbers don't make as much sense. It's more expensive for debt. It's hard to raise the equity, all these reasons. Developers are on hold.
So these builders are not building the amount of units that we're going to need in 3 years. So what you're saying is that in the future, even these bad deals right now are going to basically be able to raise their rents because there's going to be more demand for the lack of units. I think you saw that stallion go into a local place when they said they were 97% occupied. What you're saying, Ben, is that that's only going to continue as we have less places for people who are looking for homes.
Exactly. Yeah, we're going to see that absorption of the new units, really start to normalize over the next 12 months. And then you fast forward, 12, 24 months from now, we're kind of back in the same boat we were in like 4-ish years ago, where we saw these crazy rental increases because there was just no supply, right? You add on to the fact the spread between the cost of a mortgage versus the average cost of a rental is the highest that it's been in several decades.
Break that down for me. Give me an example. Yeah.
So if you're spending $1,000 on monthly rent as a renter, now you're spending maybe $2,000 on an average mortgage, right? So there's a spread. You can Google, rent to mortgage spread, and it over time, sometimes a mortgage is cheaper than rent. Sometimes rent is cheaper than a mortgage. And there's kind of this spread between them, and it's now expanded to where the cost of a mortgage is so much higher than the average rental. And what is that doing? It's causing more people to be forced to be renters, right?
And the way that actually holds out to be true is because you have people not selling properties. They're in properties that are either the owners are either have already paid them off, or they have old short-term or not old low interest rate debt that allows them to make money on that margin. So a guy goes out and buys a property today, he can't turn around and rent it and make money because the mortgage is way higher than what the market is. Is that right?
Yeah, I mean, you're kind of talking about an even bigger issue. What I'm talking about is just the pure cost of a mortgage right now are so much higher because of interest rates being higher, right? You get a mortgage at 3% versus a mortgage now at 7 or 8%. It doubles the cost. But what you're saying is even a bigger issue that's kind of driving a lot of that. Piece of it is there's just not a whole lot of supply for single family homes. We have the same problem single families are doing multifamily. And what's exacerbating that issue is people that are in current homes with low fixed rate mortgages, they're disincentivized to sell, right? So it's really pulling a huge amount of inventory off the market. And so again, it's driving up the prices of single family homes. There's just less supply, and you have higher interest rates. So you have higher prices and higher costs of debt on the prices that are now creating this really, really big gap. So, going back to the multifamily, you have these long-term fundamentals that are really support a very strong case for multifamily over the next 3 years, but in the short term, it's very challenging. So what we're doing is, because we're big believers in multifamily in general, there's a huge opportunity for those that are coming to the market. And what we're doing right now is mostly preferred equity and bridge capital. We're providing capital, not to distress properties, because, the whole other conversation, most distressed properties, in my opinion, they're just kicking the can down the road before they have a wipe or a pretty significant loss, right? Because if you bought it the wrong, pricing with the wrong debt, there's just not a whole lot you can do. And so I actually think a lot of these capital calls that people are seeing is throwing good money after bad, and you just should accept some of these as losses and move on.
Hold on. But yeah. I don't want to miss this.
Okay.
There's enough people that are listening right now, and they're like, wait a minute, did I just put bad money or good money towards bad in this deal? I like, what would be one or two questions or one or two indicators that you would say, hey, you need to back out of that deal? It's a sinking ship. Mm-hmm. Like, is there anything? I mean, obviously every deal is individualized and specific, but if I'm listening to you right now and I've been asked to put a capital call, how do I know that I'm not just doing what you just said?
100%. Yeah. I mean, I did a whole series on capital calls, 3 or 6 months ago on our podcast, because we're getting questions all the time, right? And it's a big issue because a lot of people don't know, like, am I throwing good money after bad, or am I actually protecting the capital that I already have at risk, right? And that's the tension you have, because maybe you put $100,000 into a project, maybe the capital call is only 10%, so it's like $10,000 more dollars, and I think the determination has to be, is that $10,000 truly going to protect the $100,000, or am I just extending, that I'm going to now lose the time frame before I lose $110,000? I think that's the real big challenge. So some of the things that I always say is, one, ask a lot of questions, right? Because if they're doing a capital call, something happened that they didn't expect, right? Because the goal when you're doing syndication or fund is you raise all the money plus a lot of extra on the front end to make sure you don't run into an issue where you need additional capital. So you already need to ask a lot of questions. What went wrong? Well, if the simple answer is interest costs are just more expensive, to me, that's not a really great answer, because if you're taking out floating rate debt, you should have a significant either hedge against that or a significant amount of reserves to protect against that. Now, they went up the fastest interest rates have gone up faster than any other time in history. So yes, it was an outsized event that's hard to predict, but you then have to determine what's the likelihood that this project gets to cash flow neutral. Because most of these projects, the reason to do a capital call is they've been exhausting all their cash reserves because they're cash flow negative, and try to get the cash flow positive to hold on and make it further. So the first question you got to ask is, what's the path and how quickly can you get to cash flow positive? Because if you're cash flow positive, cash flow solves a lot of problems, right? If you can actually service all your expenses and service all your debt, even if you're not making distributions, yeah, there you go. Passive income, sure, call out. Even if you can't make distributions, you can protect the equity. You can protect the property from being taken back by the bank and or being forced to liquidate at a bad time. And then the hope is, again, if you can hold out a couple of years, you can realize a better value when the cap rates come back down and you've hopefully expanded incomes.
All right, Ben, I'm going to ask you one last question. No, we're running out of time here. The question is the election. how does the election play into these movements and trends, right? Like just you've watched trends over time. I've even seen studies where it showed that when the Democrats are in office, the markets tend to soar. I don't know if that's true or not, but how do you see the macro trends? Do you see the election playing into any of this? And if so, how?
Yeah. It's a question I'm being asked probably more than any other question. And honestly, the reason why I've talked to a lot of investors recently that I'm just going to wait to invest till after the election. And yes, there's a lot of things that are kind of up in the air, and it's a pretty wild election, if we're all being honest. But, as I've, been through a few election cycles and, seen this kind of play out a few times, the reality is the election doesn't change a whole lot for most people, right? The great thing about our government is we have a 3-party system, and I'm probably less concerned about the presidency, who gets elected for that than I am, all branches of the government being one color or the other, right? Because I think that's when things can get a little bit more unique, is if it's all red or all blue. So, I'm always looking for hopefully a split government, right? Because I think that creates a lot more bottlenecks in the system, a lot more challenges in getting certain things done, whether it's I agree with it or not disagree with it. But the reality is, like, if you look at real estate, the tax code, the 1031, all the benefits that we get as real estate investors, those haven't changed in many, 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 many decades. They're not going to change. Depending on what policies or, budgets they put out, there's going to be some change, relative to the other person that becomes elected, but I don't think it's going to be significant to where people need to be concerned if this person gets elected or this person gets elected. It's, the apocalypse versus, close to the apocalypse. So I think it's something that you got to pay attention to. But as from an investor standpoint, if we're talking about private investments, talking about real estate, it's more of that's good to know. Maybe more rent controls get put in place if a Democratic president wins. Maybe we have more tax cuts that drives more job growth if Republican gets in office. But largely those things are going to not move the needle in a significant way.
So you're not concerned about the potential of having 25% on unrealized losses and all those deals that you guys have right now?
I'm not worried at all. There's no way that's ever going to get passed. That's the stupidest thing I've ever heard of. I mean, you think about it. How do they even do that? And what happens when we have unrealized losses versus unrealized gains? Like, are they going to write us a check? The government's going to write us a check for all the losses that there's just, I think it's pandering to the constituency and selling an idea that sounds good because we want to tax the rich, but it's just completely impractical. And there's no way it would ever get approved.
Oh, man, I tell you what, it doesn't ever cease to amaze me how much you understand about the markets and the way you guys are trying to get to where the puck is going. I love every time we get to chat and catch up. Having you in the mastermind is with us as well. It's always super helpful to have your perspective. For folks that want to reach out to you outside of the podcast, where would you want us to send them?
Yeah, you can just head to our website if you like, aspenfunds.us. You can learn more about the different offerings that we're working on that are kind of supported by these long-term trends that we believe in. And yeah, if you like podcasts, you can check ours out. Invest Like a Billionaire, thebillionairepodcast.com.
Awesome. Ben, thanks again for being here. And Tribe, thank you for listening. As always, if you found value, if you'll please like and share and review the show so that more and more people can get to know how to get to financial freedom as fast as possible. Thanks as always for joining us. We'll catch you on the next episode.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.